Hello everyone, I am Dr. Swati, welcoming you to Global Online Platform, the student who are preparing for NTA UGC NET June 2024 cycle. Here we are continuing our session of today, that is from the unit number 10 of the income tax and corporate tax. We are completing, and here we are taking the complete revision through the PYQs and most expected MCQs. And this is a part second, and the part one, if you haven't watched the part one, the link has been provided in the description box. After watching this full video, you can go through with this link, and I'm sure that you will get 100% benefit from this video. Okay, so let's continue. Before continuing our lecture, the new batch announcement is that is our new batch is started from the 3rd of the June, and here you will get complete course of the commerce and management, daily live lectures, recorded lectures is also available, complete syllabus notes is available in the PDF format. Okay, and full syllabus mock test is available. Then more than 4000 MCQ series we are completed over there, and the PYQs with a detailed explanation, MCQs with a detailed explanation. If you register yourself for the paper 2, then the Global Online provide you 20% discount on the fees, and in this amount 8000 rupees, if you register yourself paper 2, then paper 1 is free of cost for you. So get it. The WhatsApp number is given in your screen. Get in touch with this WhatsApp number. How to download the Global Online app? The Global Online app, go to Google Play Store, open the Global Online app, install it, and then register with your register number. And after that, you have to search, go to the My Course and search the whatever course you want. And after your registration, you will get all the paper 1 and the paper 2 in the in the systematic folders, and the record in this folder, the unit wise folders is given over there in the app, and the recorded video lectures, live lectures notification, and the materials also given in this folders. Okay, so let's start with our first question. That is a multinational company. Okay, what is about is talking about the multinational company can use which price to create a profit in a low cost, what the profit in low tax regime, and the losses in the high tax regime. Okay, the option which is given, that is a divisional price. Next option, that is interdivisional price. Third option, holding company price, and the transfer price. Okay, so it's talking about the multinational company. So multinational company, for the they having the many expenses to transfer from the one country to another country. What kind of transfer expenses they have? They have the expenses like they have transportation expenses. Okay, transportation expenses like packaging, insurance. Okay, rent, then custom fees, and etc. Okay, so these expenses are bear by the multinational company. So what they do, they use a transfer fees. What they use a transfer fees in accounting practices. That means the price that one division is an organization charge another for the supply of goods and services. Okay, so that's why the multinational company can use a price to create a low profit in a low tax regime, and loss in a high tax regime in the transfer prices. So the right answer is transfer prices. Okay, next question, that is employer. Okay, employer has provided the facility of a 1.8 liter cc car. Okay, the car is used for the private purpose also, and all the expenses include the driver salary also. Okay, are borne by the employer. Okay, the expenses of the employer during the previous year amount is 60,000. The employer has recovered 1,000 per month from the employee. from this facility. So what amount per year should be reduced by the employer from the actual amount of expenditure? Okay, so this question is from the capital. This is from the facilities is given by the employer. This is a business from the profession. Okay, so there is an employer-employer relationship. Okay, so employer providing the car facility, the 1.8 having the 1.8 liter of the CC to his employee, and also he is also pay the driver salary to driver fees along with that. Okay. Now the question is that in this question the motor car is used in the partly in the performance of the duty and partly for the private and personal purpose. Okay, so how do we calculate it? There is an already the pro forma is given, that is if it is for this 1.8 liter cc, the expenses, that is prerequisites, is allowed, that prerequisite allows is 2,400, okay, per month. Okay, and is along with the driver fees, so driver fees is 900 per month. Okay, so what is it? It is for the per month amount. We are calculating for the annually. So what we are doing over here, that is 400 plus 900 and multiplied by 12. Okay, so when we calculate it, that is a 2,400 plus 900 is 3,300 multiplied by 12. So it will be, answer is 39,600. So there is no need to calculate this amount. There is no need. There is a pro forma already given. So according to this question, what is the for the 1.8 liter cc car, the amount is which is provided per month, that is 2,400 plus 9,000 for the driver. Okay, so we added all this because here per month amount we have to calculate the yearly amount, that's why multiplied with the 12 over here, and after that we will get option number 3 as our answer, 39,600. Clear? Hope you understand this question. So the 39,600 is the right answer. What was the next question which is in your screen? What was appointed, X was appointed on 1st July. When? 1st of July as a lecturer in a university. He was continued on 13th of the April. Okay. What would be the duration of the previous year assessment year 2023-24 for the computation of the income under the salary? Okay, so what is it? The question is there is an income earned. You know that the X has appointed for from the 1st of July. Okay, from the 1st of July 2022. Clear? And from the 2022 to till December. Okay, till how do I here the income earned the current financial year. Okay, when he earned the income in the 22, in the years of 22-23. Okay, so and when he pay the tax, the assessment year is for that for 22-23, that is 23-24 is the assessment year. So what is the duration of that? The duration is from the 1st of April 2022 to 31st of March 2023. So this is what? This is a previous year when we compute our income from the head of salary, and for the what is the assessment year? 1st of April 2023 to 31st of 22, 31st of March 24. Okay, so the question is talking about is asking about what will be the duration of the previous year. Okay, so the previous year duration for the assessment year, this is 23-24 and previous year is 22 to 23. Okay, for the computation of the income under the head of salary. So the previous year we have to be is the previous year we have computing the income from the in the head of the salary. So what will the right answer? 1st April 22 to March 23. So option number 2 is right answer. Clear? Sorry. No, sorry. It's join in on the 1st of July, na? Join 1st of July. So it's we are counting from the 1st of July. From 1st of July 2022 to 31st of March 2023. Clear? Yes. Now, next question, which is in your screen, that is, which are the appropriate tax planning perspective in case of shutdown or continued decision under the Income Tax Act 1961. First of all, we have to understand what is a tax planning. Tax planning is nothing but where we are analyzing the financial situation to ensure that all the elements are working together to allow you to pay the lowest tax as possible. In the tax planning, we have to reduce our tax liability. Okay, for this we use a tax planning. So the option which is given in your is in the question, that is option the statement number 1 is A, the business loss and absorbed depreciation can be carry forward and set off against the profit and gain. So first option is about the in the Income Tax Act 1961, the set off of such unabsorbed depreciation against any other head of the income, and the remaining amount can be carry forward to the subsequent year, and the remaining unabsorbed depreciation can be utilized for set off against the income from the subsequent year. So this is the option is suitable to the tax planning, because what we are doing here the tax planning is give the reducing the tax liability. If you have earned if you have facing from the losses, if you are facing from the unabsorbed depreciation, we can carry forward to the next assessment year, and they continue until we are not settled our losses with our profit. Clear? So the option number 1 is right. Okay, statement number 1 is right. Now the statement number 2, the loss making company and the profit making company may merge to avoid the tax benefit. Okay, so this is not an appropriate answer, because a loss making company and profit making company, they may merge to avoid the tax benefit. No, for the tax benefit they do not need to merge. Okay, if the A is a loss making company and B is a profit making company, for making tax benefit they have to merge. No, they already so many things are available for the tax benefit. For the tax benefit, you can reduce it as like a set of your losses from the profit and gain. Okay, so the B option is wrong over here. Clear? Now, C or C statement, that is a tax planning of deduction under section 33AB and 115VT may be withdrawn and liable to tax for the year in which business is discontinued. So what is it? In this statement, this talking about the two deduction. The deduction under section 33AB and deduction that is a 115VT. First of all, we have to understand what is the deduction is for. Under section 33AB is the deduction is available to the tea, coffee, okay, rubber, development account. Okay, so tax benefit deduction is available to under section 33AB is for the tea, coffee and rubber making development account. Okay, and what about the 115VT, ma'am? So 115VT is available for the tonnage. Okay, so I am writing over here, that is 115 VT is for the tonnage. Okay, So what is your tonnage taxation scheme? What is tonnage taxation scheme? Let's understand. The tonnage taxation is a way of taxing the shipping company based on the net tonnage is entire fleet under the operation or uses by the company. So tonnage is used by the shipping company. Okay, and the net tonnage, the entire freight that be operation used by the company. So the section 115V 115 VZC is the Income Tax Act 1961 cover the tonnage concept. Okay. Now, what is it? The tax benefit deduction under section 33AB is reduction is available in the tea, coffee, rubber development. Okay. And the 115 BT is for the tonnage. Okay. So this is also deduction is available to the company, may be withdrawn and liable to tax for the year in which businesses discontinue. Yes, this is also true. We can use it and we can withdraw it. This all these sections. Okay, clear? We can utilize it. You can utilize in the time of shutdown, or we can in the if you are deciding to continue your business, we can utilize this reduction. We take a benefit from this reduction. So option, the statement number C is also correct over here. Now let's move toward the next, that is a D statement. The condition of the section 80IB 80IC of the Act, a deduction is allowed to such undertaking. First of all, we have to understand the section, what is section 80IB and what is section 80IC. So what is section 80IB, which is given in the Income Tax Act 1961, is provided deduction in respect of the profit and gain for the certain industry undertaking other than the infrastructural development. So here we are not including the we are including either the special kind of industry. Okay. So then what is about the 80IC? It's for the act for the short. Okay, it's a act for the short, a provision that is provided tax intensive incentives for the businesses operation in specific industry in the location of the India. So this also deduction is given. The condition of the statement is about the condition of the 80IB 80IC of the act. Deduction is allowed to such undertaking. No, we cannot use these deduction as a tax planning. Okay, so this is a special kind of deduction is given to the industry for the any other purpose, but this is not we use as a tax planning. Okay, yes. Oh, sorry. We have give me a second. Yes, we have not used these kind of deduction in the tax planning. So D is also not a right answer. Okay, then statement number E, if a person has a more than one business, okay, he has a more than one business like a on B or C. Okay, then the losses making business may not be discontinued. Okay, so why we discontinue a business? If you are suppose A, B, C are they having the different business of the person X. Okay, so if he suffer a losses from the A company, he suffer a high profit in the B company, and here is a in the C company he has a in the average stage. Okay, in the average stage. So what is he has take a decision to discontinue A. Why he has taken such kind of decision? He can set off his losses from the B company. Okay, so if the person has a more than one company, the losses may be losses making business may not be discontinued. So this is also true. This is also a part of the tax planning. Okay, we do not need to discontinue our business if we having a more than a one business. Okay, we can continue with, we are making a profit in one company, we can continue, we can merge, we can set off from the other company. Okay, so according to this, the option number A, yes, A, C and is right. So A, C is option number 4 is right. Okay, so option number 4 is right answer. Clear? Yes. Now, next question, which of the following are the correct for agriculture income? So for the agriculture income, you have been we have been familiar with the what kind of agriculture income is included in the according to the Income Tax Act 1961. So the option we have to read, then I will give you explanation of all. Okay, the first statement, income from the self growing grass, tree, bamboos. B, rent and rate derived from the land. C, income from making the produce fit for the marketing. Then income from the land used for the storing the agriculture produce. And the E, income from the warehouses. First of all, I'm giving you the answer, and after that I will give you the explanation. The option number A is right answer over here. That is a B is right, C is right, okay, and E is right. Then why, ma'am? So what, sir? First of all, understand the agriculture income. Examples of the agriculture income: income from the sale of seed is the agriculture income. Income from sale of replant tree, replant, we are plant replant tree is also sale of seed. Okay, if sale of seed is first, okay, is the agriculture income. Then sale of replant, sale of replant trees, okay, this is also agriculture income. Then third one, interest on capital received by the partner. Okay, interest on capital received by the partner engaged in agriculture, if they are engaged in agriculture. And income from the growing flower, okay, this is an also agriculture activity, na? Growing flowers and creepers, so this is also an agriculture activity. And after that, if we receive the rent, okay, that is the fifth, we receive the rent received from the agriculture land, this is also an agriculture income. And sixth one, that is profit received by the partner, okay, received by the partner. Okay, partner, if they are involved in the agriculture activity, okay, and the income from making the product fit to market, okay, that is if they are producing the product which is fit to the market, this is an also an marketing active sorry, agriculture activity. And income from the farmhouse, okay, the income from the farmhouse is also an agriculture income. Okay, so the income from the self grow grass, tree and bamboo, so this is a self grow, we are not taking any kind of effort, we cannot making the, we are not cropping and we are not doing any kind of agriculture activity over here. They are self growing grass, self growing trees, self growing, so that's why this is not a agriculture income, ma'am. Okay, now the B, the rent and rate derived from the land, we have already discussed in the point number 5, the rent derived from the agriculture land, so this is an agriculture income. Income from making the product to fit the market, this is an also agriculture income. Okay, like vegetables, they fit to the market, okay, where and the fruits, so they fit to the market. Okay, flowers, they fit to the market, so this is an for the making the product fit to the marketing, this is an agriculture income, which comes under the agriculture income. Income from the land used for storing the agriculture produce, if we are using the land of the agriculture and we are for storing the agriculture product, whatever the agriculture produce, so this is not an agriculture, comes under the agriculture income. Okay, now the income from the farmhouse, yes, it is comes under the agriculture income. So the option number A, B, C, E is the right answer. Clear? If you learn the what are the agriculture income, you can easily eliminate the non-agriculture income. So you just have to focus on the what are the agriculture income. You do not need to remember the non-agriculture income. They have a many, they can ask the question from any very many wide area. Okay, so you don't do not worry about the non-agriculture income. Just focus on the what are the agriculture incomes, which is comes under the income which is comes under the agriculture income. Clear? Okay, can I revise it for one more time? That is sales from the seeds, sales from the replant trees, okay, interest on the capital received agriculture and the growing flowers, creepers, okay, rent from the land, rent from the agriculture land, this is included. But if you are storing the agriculture product and using and receiving the income, gaining the income, this is not an agriculture. We have to confuse it many times in these two, the two concept. Okay, so rent from the agriculture income, this is an agriculture income. If we are earning from the using the storage, okay, of the agriculture product, suppose I give you the example, like there is a warehouse. Okay, we are using that warehouse to store the agriculture vegetables, fruits. So these area, okay, so these warehouse is not comes under the agriculture income. But when we using the agricultural land for for cropping and for storing, okay, we using that, okay, as a rent. So in that case, this is an agriculture income. Clear? Profit received from the partner which they are involved in the agriculture activity, this is on agriculture income. Product feed to the market like vegetables, fruits, flowers, this is an agriculture income, because we are fit to the market. This product are fit to the market because this is a necessity, okay, daily use necessity. And farmhouse, so this is and the agriculture income. Clear? Hope so you are understanding. Okay, now next question, that is it is an arts of dogging tax without actual breaking the law. Okay, so they are the concept we have to be familiar about this concept. That is, what is the tax management, what is the tax avoidance, what is the tax planning, and what is the tax evasion. So what is the tax management? Tax management is means where the legal formalities or we are maintaining the compliances with the legal formalities. Okay, okay, we are managing our tax, that is the tax management. Tax avoidance means we are using the advantages of the loopholes of law. Okay, we are using the loopholes of we are taking the advantage of the loopholes of a law. So we are using in the to reduce our tax. So this is a tax avoidance. So what is a tax planning? Tax planning means it's kind of guidance, okay, in decision making. Okay, and what is a tax evasion? Tax evasion means it is a illegal. What is it? Is a illegal, ma'am, illegal. Okay, and that's why the parties is liable for the penalty. Okay, and fine. Okay, so for the penalty, liable for the penalty. So the question is, what about it is an art of dogging the tax without actual breaking the law. We are not breaking the law, that means it is illegal. Okay, and but we are dogging the tax. Okay, so what we are doing over here, we are using the tax avoidance, because we are using a loopholes of the law. We are taking the advantage of the law, and we are not breaking, because the tax avoidance is a legal. Okay, it is a legal. Okay, that's why we are dogging the taxes. We are dogging the taxes, but we are not breaking the laws. This is a tax avoidance. Clear? Next question, which is a matching concept. Okay, list 1 is given and list 2 is given. In the list 1, the consequent outcomes is given, and in list 2, the taxation perspectives are given. We have already discussed what is the tax management, what is the tax avoidance, what is the tax evasion, and what is the tax planning. Okay. So what is the tax management? Yes, ma'am, the tax management, it is the aim of the compliances legal formalities. Okay. Then what is the tax avoidance? Tax avoidance means where we using the loopholes. Okay. So where is the loophole? The tax is reducing by taking the advantages of the loopholes. So it's match with the B or match with the second. After the tax evasion means we are punishable for the penalty, liable for the penalty. Yes, ma'am. So option the A is matched with the third, and it is then what is the planning? Planning means a guide. The last is matched with this. That is my guidance of the decision making. Okay. So A having a 3. That is A having a 3. So option number 3 is right answer. Okay. Now, next question, when the income of a minor child, what? Income of the minor child is clubbed with the income of the mother and the father, how much the deduction will be allowed to member or the to the mother and the father? The one thing we have to mention over here, that is we have to familiar with the just I'm telling you, that is the my if the minor child income is clubbed with the mother or either the father, with the person who having either mother or father who having the maximum tax liability, or they're having a higher the income. Okay. If the mother's income is higher, or if the father's income is higher, whose income is higher is clubbed with the minor child income is clubbed with them. Okay. So who having a higher income, the minus income child's income is clubbed with the higher income of parents. Okay. Now the question is, the when the income of the minor child is clubbed with the income of the mother, okay, the or the father, how much deduction will be allowed to the mother or father? So there is an already the income is already given in the tax pro forma, that is 1500 rupees per month. We have to add it in the, okay, is the exemption, okay, of a minor child. Okay. So this is the exemption, and is not included in the inclubable in the income of the parents as per the provision of the section of the minor child section. Child section exemption is given in the sense 32. Okay. Then clause 32, okay, of the Income Tax Act 1961. Clear? Next question, arrange the following advance payment of tax in ascending order. And the section is given from the section 207 to section 211 of the Income Tax Act 1961. The option, the statement is given, that is first installment of the advance tax and due date. Okay. Second statement, that is B, is liability for the payment of the advance tax. C, payment of advance tax by the assessee on record. D, condition of the liability to pay the advance tax. And E, computation of advance tax. Okay. So the option is given. We have to choose the correct option. Okay. So first of all, we have to understand the section 207 to section 2011. Okay. So the section 207 is for the liability to pay the advance tax. So this is in section 2007. 207. Sorry. Okay. The liability of the payment advance tax is it section 207. After that, the advance tax, the pay, that is 208 is for the condition. Okay. Is a condition to liable to pay the advance tax. And after that, 209 is for the computation of the advance tax, and after that liability to pay the advance tax. Okay. Okay, B, D, E, C, and after that 209 we have done 209. After that liability to pay the advance tax, that is 210 and 11 due date. Okay. Okay, sorry, liability to pay, that is no, we have right, that is C. Yes. C having this is a payment of advance tax by assessing own record. So this is a 210, and the installment of the advance tax in due date, this is 211. Clear? So according to this B, okay, B 207, then D 208, and E, okay, 209, then C, then C, that is 210, okay, and after that A. Okay, so where is our option? That is option number B, D, E, C. So option number 2 is right over here. So let's understand the concept again. Okay, so liability for the payment of the advance, when you are liable, okay, where the liability is for the advance tax is given in the 207. Okay, condition for the liability to pay the advance tax. Okay, which condition, in which condition you have liable to pay the advance tax, which is given in the section 208. Then we compute the advance tax, okay, which is given in section 209. After that, payment of the advance tax by the SSC on record. They are not paying actually, they are recording that they are doing a payment. So which is given in the section 210, and the installment of the advance tax is and the due date. Okay, so yeah, the advance tax, how to we pay the advance tax, and the in which due date we have to pay, which is given the section 211. So option number 2 is right answer for this question. Okay, yes, option number 2 is the right answer. Now, next question, tax planning involve which of the following feature? So we have already discussed what is a tax planning, right? So let's start with the statement A, that is, it is an inherent right of the taxpayer. Okay, then statement number 2, it has an originated from the very existence of the certain exemption and the deduction. Then option number C, transaction take from the colorable device. Okay, then D, that is it is a legal and acceptable jurisdiction, and it is based on the principle of the disclosure. So what is the tax planning? We have discussed in the previous slides. Okay, so what is the tax planning? It is the inherent right for the taxpayer. No, this is not the inherent right of the taxpayer. This is a planning you have to do. It has been done by the SCC or the taxpayer. It is not an inherent right of the taxpayer. So the option, the statement number 1 is wrong over here. Now, it has the tax planning, it has an organized from the every existence of the certain exemption and deduction. Yes, ma'am, because in the tax planning, we are utilizing our exemptions. Okay, and you utilizing our deduction for the proper tax planning and reducing our tax liability. Okay, tax liability. So the B option is right, because we are using the exemption and the deduction in the tax planning. Yes, ma'am. The option number C, that is statement C, is that the transaction take from the colorable device. No, 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 no. Okay. Then D, it is a legal and acceptable jurisdiction. Yes, ma'am. Tax planning is a legal and also is a given in the judiciary, that you have to plan your tax like this. Okay, you have to utilize your exemption, you have to utilize your deduction. Now, the e-statement, it is based on the principle of the disclosure. Yeah, yes, because in the we have discussed all the exemptions. We have getting this reduction. We are exempted from this area. So we have disclosed now already. We have disclosed all the things. So that's why the B and D and E. So okay, where is B, D, E? So option number 2, that is B, D, E is the right answer. Clear? Yes, B, D, E is the right answer. Now, pin money, okay, is used for pin money. What is the pin money? Pin money is a money, is actually the pin money. We have to understand what is the pin money. Then we will go through with the option, and then you will easily mark your right answer. Okay, without time telling you. Okay, so what is the pin money? Pin money means a small amount. Okay, that means small amount or the extra money that someone earn or get in order to buy the things, okay, whatever they want. Okay, so they do not really need that to purchase the things, or they want the things, but they have yes, they have money, extra money to buy this and that. So who do this? They actually do not need. The thing is, we do not need the things. Okay, we do not actually need, but we want that. Okay, so who do this kind of behavior? Yes, the women's. Yes, I'm also women, but the wife. Okay, they need a pin money to buy. Yes, I need extra money to buy this, that. We actually do not need to purchase extra earrings. We do not need to purchase extra necklace, but we want it. Okay, so this is a pin money. So I'm uh, uh, now I'm explaining you the now I am just reading the options, and you have to correct it. I'm not giving the right answer to you. You have to comment in the comment box. Okay, so what is the pin money? The statement number 1, that is a receipt on the account of the dharmashala and goshala. Statement 2, woman get from her husband a certain amount, income from non-resident from the shipping the business, and income from the building used for the agriculture. So you have to answer this. Okay, we have already mark it, but you have to answer me in the comment box. Okay, what is the pink money, and what is the right answer for this question, for that question. Okay, so next question, which is in your screen: which are the condition in which a unilateral means a one. Okay, unilateral means a one, relief is granted in case where the section 90 is not applicable in this income tax. So in this section 90 is is for the unilateral relief, okay, against the double taxation. Okay, the is section 90 is to avoid, okay, or getting a unilateral relief. Okay, we can say avoidance of double taxation. Okay, double taxation. So section number 90 is for the avoiding the double taxation. Clear? Now the statement is given, that is assessee should be resident of India. You if you are known with what is in actually in the section 90, in the which is for the avoidance of the double taxation. So I will tell you, the first of all, I am telling you the conditions. Okay, so the first condition, that is the individual or corporation should have been the resident of India. So first one, that is they should have been resident of India. Clear? In the previous year. Okay, in the previous year. Then the second condition is income should be have been accrued the taxpayer or receive them outside in India. Okay, so they received or pay. Okay, they received or pay the tax outside in India. Okay, India in the previous year. Okay, and then the third condition, that is income should have been taxed both India and foreign country, either you can say outside India. Outside India. Okay, and the fourth one I'm writing over here, that is fourth one, individual corporation should have paid a tax in the foreign country. Okay, they also the assessee also paying tax to foreign country. Okay, country. Okay, so these are the condition under section which is given in the under section 90, avoidance of the double taxation. So what is happening over here? You know that the condition is when you are getting a relief. Okay, the relief is given if they should have been resident of India, they have in the previous year. If they have, their person is having a residence of India previous year, they eligible for the relief from the double taxation. Okay, and he pay or receive either he pay or he receive the income in outside the India in the previous year. Okay, and also the India, he is also paying the tax in India and outside in India also. Okay, and he also paying the tax to the foreign country. So in that case, what is happening if you are a assessee? Okay, just assume that you are an assessee. You're sometime you're living in the outside, you're sometime outside the India and living foreign country, or you're living in India. So what is happening here? You have to pay the tax to the foreign country also and to the India also. So that's why the double, you have faced a double burden in your head. So what is the Income Tax Act 1961 in the section 90 give the relief to the unilateral relief to the such kind of assessee. Okay, so what are the conditions? I'm reading the statement, and I am sure that you are able to answer this question. Now, the first statement, the assessee should be resident of India in previous year. Yes, ma'am, we have already discussed in the first statement. The income should have been accrued in outside in India. Yes, this is also true, ma'am. The assessee should not have paid the tax in such a foreign country by the deduct. Okay, so it is comes under no, ma'am, because he have to pay, should not, no, have to pay the tax in the foreign country, which we have discussed in the fourth point. Okay, the income should not accrued in outside in India. Is this? No, the income should be accrued in India or outside the India. So both they are earning from India and outside from the India. So this is also this is not a right statement. The income should be taxed in the both India and foreign country in which India has a no agreement for the relief. Okay. So the option number D is right answer. Statement is also right. So A, B, E. Where is it? A, B, E. So option number A is right answer here. Can I repeat it? Yes, ma'am. First thing, that is section number 90 is for the unilateral relief, okay, which is given by the by the Income Tax Act 1961 to the taxpayer who are sometime they are living in India and sometime they are living outside India. They are earning from the India and earning from the outside in India. So they are facing the burden of the double taxation. Okay, so they're giving the relief to such kind of a SSC. Those SEC, the such this section number 90 is given to them. Okay, and what are the condition of the section 90? They should have been the resident of India in the previous year, ma'am. Yes, they receive or pay the income outside in India or in the previous year. Okay, then they are taxable in the outside in India and the India also. And fourth one, that is they paying the tax to the foreign country. Clear? Hope you are understand this concept, because this is a really important. Okay, yes, option number A is right answer. Then when no liability for the payment of tax in advance arises from an assessee on his income if tax is payable. Okay, when no liability of the payment of the advance tax is arises by the assessee. So what is the limit? Actually is asking about the limit. If the assessee is taxable income is less than 10,000. okay, less than 10,000, in that condition, he has not liable to pay the advance tax. Okay, so the option number A is less than 10,000 is right. There is an no. Okay, so the less than 10,000 is the right answer. If the SEC having the less than 10,000 taxable income, in that condition, he is not eligible or not liable for the payment of the tax in the advance. Clear? Now, a business has been discontinued. This is the next question. That is, a business has been discontinued in the previous year, 2021-22, the business loss. So what we do, the statement number 1 can be carried forward and set off against the profit against the business and losses. Statement 2 can be set off against the income from the business and profession in the income under the heads of the other heads, and can be carried forward and set off or indefinite period whether the business is carried or discontinue. Them can be carried forward as set up for the 6 year whether the business is carried or discontinued. So what is the right answer? What is the right answer? Yes, the right answer is we are the option number A, that is can be carried forward or set up against the, because this is the losses from the business. So it has to be carry forward or set off against the profit gain from the business and profession. Okay, so these are the can be set off against the income from the business and profession under the another head. No, we have to, first of all we have to set off and set off with the business and profession in the same head. Okay, can be carried forward and set off in the indefinite period. No ma'am, not for the indefinite period. Then they can be set off for the set of 6 years. No, there's no such kind of provision is given in the Income Tax Act 1961. Okay, as simple as. Now, next question which is in your screen, what are the correct steps of the procedure of the e-filing the income tax return? Okay. The first one, that is filling the detail and computation of the taxes. So here is asking about the procedure of e-filing the income tax. So okay, I'm not explaining you, I'm just giving you the example and you will tell me about the what are the procedure. Okay, if you are downloading the app, okay, if you're downloading the global online app, so what is happening when you download the app, you have to, first of all, they are asking for the registration. Okay, either registration or the login. Okay, if you're the first time user, then you have to register. Okay, and if you are already registered over here, or already you're registered with your mobile number or the login id, email id, so here you have to just put the password. So what is the first procedure? What you do, that is a registration and the login on the portal and the select the application and return form. This is the first procedure. Yes, you have to download the global online, you register yourself. Then what is the next step? That is you're filling the details and the computation of the taxes. So for the option number C is the first step. So where is it? Yes, option number C is here. So we are just enumerating the all the options. So option number C is 2 is right answer over here. But now I'm discussing the more one. After that, what we do? We fill the details, ma'am, and okay, and after filling all the details, we compute the taxes. What after that? After that, making the payment. Okay, what you do? Well, whatever the course you do, you want, you do what you do, you make the payment. Okay, you make a payment. Just you don't need to read all much and understand the full statement. You have to pick at the time of examination, you have to pick only the words which are exactly matched to your whole sentence. Okay, so what is you have to do? We make a payment, ma'am. Okay, and what the balance of the taxes and contain the data provided, whatever it is, you have to make a payment. And after that, making the payment, what is the files you will get. Okay, the files you will get, that means generation of the XML, okay, files, and filing the return, tax return, and user digital signature. So this is the procedure. Now after that, what we use the ITR form. After that, we use the ITR form and sending the ITR form to the CPD. In this kind of statement, you don't need to match each and every statement. you match the 1 and 2, startings 1 and 2 and ending last. Okay, so you get the answer. Okay, so we have get the answer in the when we select the first statement. Okay, now the next question. uh we all again the match and list is given. So this is question is really important, because in this question we are covering a many the percentage of the TDS. Okay, so the list is given for the person is non-resident in India, sorry, non-resident, and the rate of the deduction of the taxes, that means the TDS. Okay, it's talking about the TDS. First of all, have to understand the TDS. It is an indirect tax. Yes ma'am, it is an indirect tax. Okay, this is an indirect tax. Sorry, this is not indirect tax. It's an indirect way. Indirect way by which you collect income tax at the source by the government of the India. Okay, by the government, and TDS is levied on the income earned from the incentive. Where you are, where we get in the TDS in the kinds of incentive. Okay, commission. Okay, dividend. Okay, then the service render, sales, rent, purchase of the immovable property. Okay, and the fixed deposit, FD. Okay, in the FD they also deduct the TDS. In the sales of sales of immovable property, they also deduct the TDS. So what percentage they have to deduct? So this is the question. Okay, so first thing, the question, the maximum rate is levied in the TDS is from the winning houses, because this is a speculation, this is nothing but a betting. So if you are betting, if you are take this such kind of this is not a actually this is not a legal, you know. So this kind of practices, in that what case the maximum deduction in the houses, so that is a 30%. You marked it. Okay, so C having a first, C having a first, C having a first. Okay, and after that you know that in the short term, okay, short term capital gain, they in their according to the section 111A, the income tax levies the TDS, that is a 15%. Okay, the 15%, that is B having a 4. Okay, B having a 4, C having a 1, so we get an answer. Now if in kind of deduction income, the TDS is the TDS is levied on 20%, in which in the dividend. Okay, and on the way of royalty fees. Okay, royalty fees, they have to pay 10% for the technical services they are paying. So there is a less percentage. So the option number 3 is right answer over here. Again I'm repeating, for the dividend 20%, for the short term 15%, for the horse racing 30%, for the royalty fees 10%. Clear? Now, yes, option number 3 is the right answer. Then next question, which expenses are expressly disallowed under the profit from the business and provision, that is PGBP. Okay, so which expenses are expressly disallowed? They are not allowed in the PGBP. So let's I'm reading the statement. Salary paid out India on the non-resident salaries comes under the PGBP. No ma'am, this is cut. This is not comes under the. Okay. Ek minute. Just give me a second. No. Which expenses, okay, are expressly disallowed in the PGBP. Salary paid out of India is not in India. Okay, it's out of India and non-resident in India. So it is allowed. This expenses is allowed under the PGBP. Okay, now the wealth tax is also allowed in the PGBP, because wealth tax is a part of the PGBP. Okay, then the payment to any rural development program, this is not a part of PGBP. Rural development program is not a part of PGBP, so this expenses is not allowed in the PGBP. Okay, Then expenditure incurred by the company on the notifying the skill development. Okay, skill develop project. So this expenditure, this expenses is also is not disallowed. Okay. And interest royalty fees payable outside India. Outside India, yes, yes, it is allowable. So the A, B, E, yes, fourth option number 4 is right answer. Okay. Now I'm just telling the sections which is come the interest and loyalty. Okay, interest and loyalty is comes under the section 40A subsection 1. Okay, 40A subsection, the interest royalty fees payable outside in India. So this is given in the 40A 1, and disallowed expenses in the payment or credit to the residents, non-residents. Okay, so it's given in the section 40A 1A. Okay, and the for the then again the loyalty, yes, salary payable the outside is given in the 40A 3. Okay, yes. So we are completing over here near about 17th question. Okay, 17 to 18th question. So we are continuing more questions. Okay, till the examination, and which will help you for preparing well for your examination. So best of luck and do your best, and do study. Okay, thank you.